Hey everyone, Aaron Shetty here. You know how I always say building wealth is about more than just stocks? Well, today we're diving into the world of bonds. Now I know what you might be thinking. Bonds? Sounds kind of boring, right? But trust me on this, bonds can be your secret weapon to a more stable and diversified portfolio, especially if you're looking for that consistent stream of income. Think of it like this, stocks are like that exciting startup you invest in, potential for big growth, but also a bit of a roller coaster. Bonds, on the other hand, are like that reliable dividend-paying company, slow and steady wins the race, right? They offer that stability and predictable returns that can help you sleep better at night, especially when the market gets a little crazy. So, whether you're just starting out or you're a seasoned investor looking to diversify, this video is your one-stop shop for all things bonds. We're breaking it all down, from the different types of bonds you can buy to actually making those purchases. By the end of this video, you'll have the knowledge to start building that bond portfolio and start earning that passive income. Let's get started. Before you jump headfirst into the world of bonds, it's crucial to understand the different flavors they come in. This isn't like picking out your favorite ice cream, though I wish it were that simple. You see, each type of bond comes with its own risk profile and potential returns. First up, we've got government bonds. These are like the gold standard issued by the government itself. They're considered the safest bet since, the government isn't going anywhere anytime soon. Then we've got municipal bonds, issued by local governments or state-affiliated entities. These can offer tax advantages, which is always a plus. And of course, we can't forget about corporate bonds. These are issued by companies looking to raise capital. Now, these generally carry a bit more risk than government bonds, but they can also offer juicier returns. Finally, we have sovereign gold bonds, where you essentially lend money to the government, and your return is linked to the price of gold. Now that you've got a handle on the different types of bonds, let's talk about how you actually buy these bad boys. You've got options, my friend, just like your favorite all-you-can-eat buffet. You can go the traditional route and buy through a broker. This is a good option if you want a bit more hand-holding and personalized advice. But hey, we're in the digital age, right? So, naturally, you can also buy bonds online through various platforms. These platforms are great because they often have lower fees and can be super user-friendly, even for beginner investors. If you're in India, RBI Retail Direct is a fantastic option. It's directly run by the Reserve Bank of India, so you know it's legit. And then there's the good old mutual fund or ETF route where you're basically investing in a basket of bonds. This is a great way to diversify easily without having to pick and choose individual bonds yourself. Alright, ready to open some doors to the bond market? Just like getting into that exclusive club, you're going to need the right access. Don't worry, it's not as complicated as it sounds. If you're going the broker or online platform route, you'll typically need a trading account. This is where you'll place your buy and sell orders, kind of like your bond command center, and in many cases, you'll also need a Demat account. This is where your bonds will be held electronically. Super convenient. But if you're going with RBI Retail Direct, things are even simpler. All you need to do is register on their platform, complete your KYC verification, and link your bank account. It's like signing up for a social media account, but instead of posting selfies, you're building wealth. Now that you've got the keys to the bond kingdom, it's time to talk strategy. Remember, we're not just throwing darts at a board here. We're making calculated decisions to build that wealth. Before you hit that buy button on any bond, you need to put on your detective hat and do some digging. First up, the coupon rate. This is the fixed interest rate the bond pays you, usually semi-annually. Think of it like your regular paycheck from the bond issuer. Next, we've got the yield to maturity, or YTM. This takes into account the bond's current price, coupon payments, and how long until it matures, giving you a more complete picture of potential returns. And of course, you've got to check out the credit rating. This is like a report card for the bond issuer, telling you how likely they are to repay their debts. The higher the rating, the lower the risk. Alright, you've done your homework, analyzed those bond features, and are ready to pull the trigger. Placing a bond order is actually pretty straightforward, especially with online platforms these days. First things first, choose the bond that aligns with your risk tolerance and return expectations. Remember, higher potential returns usually come with higher risk, so find that sweet spot that lets you sleep at night. Once you've found your match, simply enter the bond details and the amount you want to invest on your chosen platform. Now, here's a pro tip. Some platforms even offer bonds in denominations as low as 1,000 rupees or $100. This means you don't need a mountain of cash to get started. You can dip your toes in and gradually build your bond portfolio over time. If you're buying bonds during a primary issuance, which is when they're first offered, you'll participate in an auction-like process where you submit your bid. Congratulations, you're officially a bond investor. Now comes the fun part, deciding what to do with those bonds you just purchased. You essentially have two main options, hold or trade. If you're in it for the long haul and want that steady stream of income, holding your bonds until maturity is the way to go. You'll receive those sweet coupon payments like clockwork, and once the bond matures, you'll get your principal back. But hey, sometimes life throws you a curveball, or you might spot a great trading opportunity in the secondary market. That's the beauty of bonds. They can provide some liquidity when you need it. If you decide to sell before maturity, the price you get will depend on factors like prevailing interest rates and the bond's creditworthiness. Now, just because you've bought some bonds doesn't mean you can just set it and forget it. Remember, building wealth is an active endeavor. It's crucial to keep a watchful eye on your bond investments and make adjustments as needed. Keep track of those interest payouts and mark those maturity dates on your calendar so you know when to expect those cash flows. Also, remember how interest rates can fluctuate? Well, if interest rates rise after you've bought your bonds, the value of your existing bonds might decrease in the secondary market. And of course, credit risk can change over time. It's always a good idea to periodically reassess your bond holdings to make sure they still align with your risk tolerance and investment goals. There you have it, your crash course in bond investing. Remember, bonds can be a fantastic addition to any well-rounded portfolio, providing stability, income, and diversification. But as with any investment, it's all about making informed decisions. If you're new to the bond game and feeling a bit risk-averse, sticking to high-rated bonds, those with AAA or AA ratings, is a smart move. And just like you wouldn't put all your eggs in one basket, diversify your bond holdings across different issuers and maturities. You can even use a strategy called bond laddering, where you stagger your bond maturities to manage interest rate risk. Most importantly, remember that knowledge is power. The more you understand about bonds, interest rates, and credit risk, the better equipped you'll be to make smart investment decisions. Keep learning, stay updated on RBI and central bank policies, and watch your wealth grow.